Corporate finance practice problem using OneNote. Ex-dividend stock price. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, Practice Problems tab, down in the 1822 ex-dividend stock price tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations will be down here in the text area as well. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculations down below. Ex-dividend stock price, the ex-dividend stock price being the stock price after the stock is trading and no longer having the available next dividend that is going to be included in it, and therefore you would think the stock price decreasing by, in essence, the value of that dividend. So if the market price the day before the stock goes ex-dividend is 60 and the annual dividend yield is 7%, dividends go out on a quarterly basis, then we want to think about what will be the ex-dividend stock price, which we would think would go down by the fact that that next payment, that next dividend, is no longer included in the stock price. Note here that we have the quarterly dividends that are going out on a quarterly basis, throwing another kind of wrinkle into the calculation. So if we got the stock decrease after the ex-dividend, the annual dividend yield we said was 7%. So that's on an annual basis that we're being given the yield. The stock price is $60. So if we take then trusty calculator, 0.07 times the $60. Remember that the $60, of course, is the market price. It's not something that's in the company. That's a market thing determined by the market. And if we had a publicly traded company, it would be readily available to us. We're taking the 60 times the 7% on the yield, giving us the yield of the 4.2, so $4.20. And then we need to take, that would be the annual because we had the annual dividend yield given. And now we need to take into consideration the fact that the dividends are paid out quarterly. So we'll take that 4.20 and we'll divide it by 4. So we'll divide by 4, and that's going to give us our 1.05 or $1.05. So we're going to say that the next dividend, $1.05 for the quarterly dividends. Therefore, if we have the ex-dividend stock price, which no longer includes, meaning the person buying the stock at this point in time is not going to be getting that dividend, that $1.05 dividend, because it's after the cutoff date. Therefore, we think the stock price should go down. It was what we would assume to happen then. Obviously, the stock price driven by the market, but this is what the assumption would be. The stock price with the dividend of 60, and then the stock decreases by 1.05, giving us the 58.95 as the ex-dividend stock price.